Hi, long time no see. I've been traveling around for work a lot recently and I haven't been able to make any videos. So I'm tired, I've just got back. Can we just make a portfolio update with the stocks I'm buying at the moment? How's that sound? I'll fly through this. I'll take you through everything that's in my portfolio at the moment. I'll take you through the things that I really like about trading 212 at the moment. And I will show you all of my data from my dividend payments and what I'm expecting to come. Right now, my portfolio is at 106,857. It has been a lot higher than that in the past, but recently we've had this crazy ass downturn. And guess what? I'm probably buying into it. That shouldn't surprise people right now. I just keep buying all the time. Everything that I own is still in Trading 212, all in these 24 investments. And I compare myself with the VWRL benchmark. It's what I probably would have invested in if I had just gone into index funds. 5% of all my deposits go straight into VWRL, and that's to compare it against my warm and creamy pie. What I love about Trading 212 at the moment is this Hot Conversations tab. It's absolutely incredible getting up to date with the community in Trading 212, just talking to everybody. Yeah, some people are knobheads on there. They definitely are, but that's fine. It's all about the conversation. It's all about talking to different people and getting different points of views. Sometimes the knobheads do have a good point of view. And number one on the list right now is Position Hunter. That is, if you remember Steve, one of the Steves from the Playing Footsie podcast. He's getting to grips with the biggest investment of regret today. But what I really like now is the Trading 212 front page. There's lots and lots to see on here. You get a full update of news. And I just think this app has gone from strength to strength. You get to talk to so many different people. You get all of your news updates right here. I think it's incredible. But my pie, if you want to see it, you just go to my profile. I think you just click on my pies section and then click on the warm and creamy pie and you will see all of my investments held within the warm and creamy pie. A little bit of shuffling around going on. I don't want to shuffle too much. I realize I've done way too much of that over the past few years. But this portfolio probably looks quite different now to what it did a few years ago. There's a few of the regulars in there. Tyson Foods, Walt Disney, Rio Tinto is back in there. Along with lots of different companies, even AT&T. I put in about 2K into this very, very recently, probably around February, something like that. Don't get your hopes up that this is going to go back up to these levels. This is just something to mess with the recovery, take the dividend, take the cash flow. I like it. As for dividends, this is a dividend growth focused portfolio. My portfolio is doing okay against the VWRL and VUSA benchmark. We're currently beating it by 0.861% as of August, and you can see that I've kind of trailed it. Some would question whether that's been worth it. Should I just put it into the index? But the idea is that you're generally going to maintain with the index every 5 years, and then one of those every 5 years, maybe even one of those 10 years, you're just going to do a lot better. And that's what we're waiting for. We're waiting for that 1 year where I do a hell of a lot better and kind of break away from that VWL benchmark. It might happen, might not. This whole channel was built as an experiment to see if dividend growth investing worked. So far, it's doing okay. We'll see. Long term, depends what you call long term. I'm beating the market after 5 years. Am I going to still be beating it after 10? Very hard to do. Near impossible. I'm fully aware of that. This is all about learning. At the moment, my total return is 25,721. That's after 4.5 years, and that's a total return of 30.15%. The total as of the end of August was 111,000. Obviously, after this dip recently, we've kind of tailed off a bit. 20% of that total return has come from dividends. So dividends play quite a significant part of my total return in this portfolio, and a full £85,000 of deposits. And this little graph here is what I've been trying to build over the past few years. I've been trying really to show that this dividend compounding thing actually works, that we can grow the amount of dividends that we're paid over the years. Yes, a lot of this is just because I've been depositing so much, and that's because it's early in the game. But eventually, what we should start to see is this line, this red or pinky line, going right up. Right now, by February 2025, it predicts that I'll be earning almost £400 a month. But you can see that it is growing. It is doing what it was supposed to do. Back in January 2020, when this all first started, we weren't sure. But now we're starting to see this growth starting to happen. We're starting to prove that it might actually work. For funsies, I track my daily, monthly, yearly, weekly, and hourly wage. In 2024, we're currently earning 54 pence an hour. This is based on 1,950 hours per year worked, and we're earning £2.90 a day. This allows me to almost retire in Pakistan. I'm hoping as the years go on, we start to be able to retire in much more reasonable places like Venezuela. Yep. The Philippines. That'd be nice. And Turkey. Turkey would be an interesting place to retire. I wonder if I'd be able to afford actual nice places in Turkey. We'll see. I always like to compare this with my compound interest calculator prediction. What I've done is I've set a date of 20 years at 5% growth. So this is my kind of base case scenario. This is the amount of money I would like at its absolute minimum. I think at 4% dividend yield, I can get around 20 grand a year. And I think I personally can live off that. A lot of people don't think that they can live off that, and that's perfectly fine. No one's crazy. This personal finance is personal, all that crap. But based on a deposit of 1,666 a month, which has so far been actually quite realistic for me, by year 4, I should be hitting 88,000. And by year 5, we're at 4.5 years right now. By year 5, I should be hitting 113,000. And currently, I'm at 106,886, which means for my worst case scenario, I'm actually hitting it. So I'm hitting exactly where I need to be. My best case scenario, which I've played out here, and I keep it in my dividend formula, is £981,308. That's at the end of the 20 years. That's at an 8% base rate, and that's basically the return that you should be able to expect from the S&P 500 if you were to put it in the index fund. And at 4 years, I should have earned 93,000, and at 5 years, I should be on 122,000. So even in my best case scenario, I'm actually quite in the middle of that. But I also have 14,600 left to deposit this year. So in fact, if I keep this going, I might actually beat the top level target as well for this year. That'd be pretty cool. I think that covers everything that I need to with the update on my portfolio. I can go into a lot more detail about some of these stocks, but let's think one at a time. I'm fucking tired. But if you want to chat about it, you can leave a comment in the description below. Or what's even better is go onto the Trading 212 social feed. It's a really cool way to get in touch with people. I just post memes all the time. It's a bit of fun. But yeah, there you go. You can see me. I've kind of been on a helicopter recently getting away from work. And this is where I mostly spend my social media time now, because it just seems to be the best place to talk to people who are interested in the same things that I'm interested in, whether their opinion is completely different to mine or not. Although chill out with the politics on here. It's fucking hell. Okay, so now time to get to the stocks that I'm thinking of buying. It's a tough time to buy at the minute with the S&P 500 at a P of 23 times earnings, and it looks like we could be setting ourselves up for another lost decade. Lost decades happen all the time. It's not unusual. There was one in 2008, I think. But people recover from that. We all recover from that eventually. And the dream of that payoff at the end, that £900,000, is all based on me continuing to invest, even though these prices seem really high and they're really scary. I get it. At the moment, over the next 3 years, if we were to stick to a really basic value investing model, we could be looking at 5% of negative returns over the next 3 years. That is all well and good. To be honest with you, over the past 10 years, 15 years, nearly 15 years, that prediction and the value investing for the entire S&P 500 just hasn't really been true. On occasions, yes, we've had that reversion to the mean, but in general, the trend is getting away. And we don't actually know how far away from the earnings trend the price is going to be. Okay, let's start with Alphabet. Alphabet is one of the biggest holdings in my portfolio, and it's been pretty much up and down. I've been buying from about here at a 90, and I've been consistently buying it up all the way to the top. And recently we've had this pullback. So let's find out if Alphabet is actually undervalued at the moment. And I kind of believe so. Alphabet is currently at a 21 blended PE. This blended PE right here is a average basically between the trailing PE and the forward PE. And when I'm working with FastGraphs, by the way, there's a FastGraphs affiliate link in the description below. Affiliate 25, the code at the end, and you get 25% off this if you want to try it. But working with FastGraphs, I tend to use two different types of metrics. I use the operating earnings and I'll use the free cash flow growth at the same time. Free cash flow growth rate for Alphabet at 18.7, and we've got an earnings growth of 20%. That's pretty good growth. It demands that 21 PE. I like Alphabet for its cloud computing. I like it for its home. I like it for its TV. I use all of this stuff at home. So this is one of the reasons why I should be investing in it. I really do like how seamless it works at home. I haven't heard any problems. I know there's problems with the Amazon side of it. There's Google Cloud. I use Google Docs right here to write my dividend payments worksheet. It's free, so I don't know how they're going to earn the money off me on that one. Good point. I'm a big fan of Waymo. I'm a big fan of robo-taxis in general. I'm hoping to get into a Waymo in the next couple of months. Watch this space. And of course, cloud, tensor chips, AI, Gemini, I absolutely love. I use it to write all of my essays. And to be honest, it's written a lot of job interviews for me as well, which is quite cool. So I'm a big fan of Alphabet and Google in general. I think that the search bar, even though I've been using Microsoft's Bing recently, it was actually really good. I got forced to use it. I was on a Works laptop which didn't have Chrome. So everything got routed through Bing. And if I'm honest, Bing's pretty good. Bing, there was nothing wrong with it. It used Copilot to answer some of the questions. I thought it was really good. And Google's doing exactly the same thing now. But as long as that money continues to come in from search, Google can keep trying to do different things. And it's doing pretty well at all of them, to be honest. However, we're told that the Mag 7 is taking up way too much space in the S&P 500 market cap, so it's clearly overvalued. We can use FastGraphs to take a very basic guess at what Google's price growth might be over the next few years based on a 20 times earnings ratio at the end. This could net us 13.3% per year for the next few years. However, this 20 times fair value seems a little bit high. Basically, this 20 times fair value is based on the rate of growth. So put simply, FastGraphs does a little calculation that decides what the end PE growth should be for this company based on their actual earnings growth. The higher the earnings growth, the higher the PE. Sometimes they end up at like 30 PE. Tesla was a good example of that. Sometimes they end up at like 4, and that's just when the earnings are in decline. So FastGraphs does put quite high hopes onto Alphabet's valuation here. But we can change that. By going to my forecasting and going to custom, I can get the analyst estimates on earnings growth right here. And so far, what we've got this year is a possible EPS of £5.80. That's a 27% year-on-year growth. And that's based on 55 analysts guessing that. Next year, analysts reckon there's 31%. That's based on 59 analysts. And analysts have guessed out up until 2026. Quite a few analysts. That's 60 and 36 guessing out till 2026. Based on this outlook, a 17 PE ratio, and then 18.51% in terminal growth value, which we will change, you can guess that we're going to get that 13.94%. Now that, in my personal opinion, is best case scenario. However, in FastGraphs, I can make these earnings estimates whatever I want them to be. I can make these earnings estimates really, really poor to see if we can get that margin of safety. So if I have it at 6, 7, 9, 10, 11, and 12, We then kind of come up with an average of 10% earnings growth there. And we've significantly nerfed the earnings growth. We've made it a lot tougher for Google to actually grow. We've almost halved it, in fact. And then what we can also say is that because the earnings growth has gone down, we can now bring the PE ratio down as well. So because growth isn't as good as expected, the PE ratio needs to come down as well. And the average PE ratio for pretty much any company in the S&P 500 is around 15. And if we click on the end terminal value of 15 PE ratio, we end up with an earnings growth of 4.24% year on year. That's over the next 5 years up until 2029. So in simple terms, I've reduced the end PE ratio, I've reduced the earnings growth almost by half, and I'm still going to make money. This is a very basic way of suggesting that this company has a bit of margin of safety. That there is, if things go wrong, if things don't go as well as we expected with Alphabet and Google, we still might earn money. We can even just make it a little bit worse. So in 2029, we only have an earnings per share of $11. And then we'll look to bring the PE ratio down to 13 because the situation's got even worse. And we still end up with just notching a profit. It's close, but we don't lose any money. And if it gets really bad, we actually only lose 3% a year. And those aren't bad odds to me. For this reason, over the next couple of weeks, as soon as I get a bit of money, I'm going to be putting in a lot more into Alphabet because I do believe this business has got something going. The downside to Google is that it's always coming in second. While it's had tremendous growth over the years in price and in earnings, Google does have some issues. Search is being encroached on, and that's a huge business for them. It makes so much money. YouTube has to compete with the other streaming services. Do we know if that will continue? At the moment, the answer is yes. But there's always issues in the future that might crop up. I can see me adding another £1,000 to Alphabet and trying to get that over the £10,000 mark. I think it's ready for a big burst, and I'm willing to hold that for a lot longer. Next, one that may surprise a few people is Nvidia. I can see this. I can see Nvidia. This is surprising. Nvidia has had this huge run up, but the earnings have kept pace with it. We all know that. That's not new news. However, the earnings growth has been very high for the past few years. Fastcash rates it at a 30 times valuation. That's basically the highest it can go. It can't go any higher than that. And if we take the simple calculation again, it could still go. We're still making 12.49% year on year, even at these ridiculous levels. But these are huge amounts of growth. And how long exactly can these be sustained? Free cash flow is also doing exactly the same job. It's absolutely incredible growth. Another 9% is easily added on based on free cash flow as well. So how can we find out what the worst case scenario is for Nvidia? We do exactly the same thing. We go to our custom, go to the estimates, and we see that earnings estimates just hitting the ceiling at 30 times earnings. We'll change that. This year, change of 288%. That is just what it is, which is insane amounts of growth. Analysts predict that it's going to go up another 100% next year, 38% the year after, and then we're going to start ending up at a terminal value, growth value of 28%. Too high. We'll change that. But with these crazy earnings, and yes, they are real earnings. These are not predictions or nothing. Nvidia is growing this fast, and it's growing this fast from Mag 7 companies. Mag 7 companies are giving them the money to grow this fast. So it isn't exactly like the dot-com bubble anymore. It's big companies which are investing in a lot of cash in probably the next wave of technology. Okay, but what if we kind of halved the amount of growth next year, and then we did kind of the same the year after that, and then after that we kept it at kind of low double digits? So what we'd be seeing really here is just Nvidia not collapsing but slowing growth and falling out of favor. And then we brought the PE ratio down to 21, or we could go even lower than that. We could bring it to 17. Well, let's bring it to 20. Let's keep the PE ratio at 20. At a PE ratio of 20, we start to lose money. We start to lose 1.1% a year. Now, what I've done here is I've basically halved the PE ratio because the current PE ratio is about 40. I've dropped their earnings growth by over 50% for the next 5 years, 6 years. Do we see that happening? Do we think that Nvidia is going to drop 50% in expected earnings this year? I mean, it could drop by 10, but even that would still be 100% in earnings growth for the next year. It just doesn't seem like it's going to happen. But even with this huge drop in earnings, this pullback in sales, it still kind of earns money. It still doesn't have too much of an effect on the share price. It's going to take a hell of a lot for Nvidia to completely collapse like this, and we still kind of only end up with a straight return. I like these odds. I like what we're seeing here, and if we were to keep it at the analyst estimates, but if we had the PE at 20 in the next 5-6 years, we're going to earn 12.13% year on year. So that's an extra 12% getting added to the portfolio every single year if we own Nvidia. And I've kind of convinced myself that Nvidia is in the right place now. It's proven its earnings growth. It's proven that it's going to sell. It's quite far ahead of any of the competition. It's pretty good here. I can't do this for Microsoft, though. I've really tried. Microsoft is just way too overvalued at the moment. I own Microsoft. I own quite a bit of Microsoft. It probably makes up 6 or 7% of my pie. £6,195 I have in Microsoft. I've done the same thing here for Microsoft. I've reduced down the earnings growth quite a bit to get that real worst case scenario, what could happen. I've made the PE 15 because it's an old ass company and it might not grow as quickly as the other companies do. You see, it's only 20% growth this year, 11% next year, 16% the year after that. These are all based on 50, 51, 48 analyst estimates, which is exceptional growth. I mean, you'd go back 5 years and you told me that your company was growing 20%, I'd go, whoa, that's incredible. But if Microsoft wasn't able to keep up this 20% growth year on year, which it probably isn't going to, and it drops to the 15 PE ratio, we now end up with a loss of 1.46 a year. That is a bit too much of a risk. There's no real upside risk to suggest that Microsoft is going to outperform the market. In fact, it could quite possibly stay quite flat over the next few years. With that in mind, I don't think Microsoft, for me, is a buy right here, and I'm definitely going to keep holding it. Rio Tinto's been flat a long time, and it's about to get a bit worse. Lowering commodity prices, particularly in iron, because China has decided that it's not building anymore, could cause real problems for Rio Tinto. It's definitely going to cause that dividend cut. Well, I'm almost certain it's going to cause a dividend cut because Rio Tinto grows its dividend over time, but also allows a cut and growth at different points when it does really, really well. Right now, it's not doing really, really well, and we need to see if it will ever recover. I'm pretty confident that one day Rio Tinto will recover. I reckon one day the iron ore market will one day recover, and I think that people will start building again. It's just we're going through a bit of a nuclear winter at the moment. Well, almost literally real nuclear winter. But if nuclear weapons are actually used, then there's no point in the stock market at all. With Rio Tinto being such a damaged stock, we can look at it in the opposite way that I have for Nvidia and for Alphabet. In 2023, we've seen a 16.34 drop in the earnings per share. In 2024, based on 20 analyst predictions, they see a 4.6% drop in earnings per share. And next year, it starts to get a little bit more rosy with a 1.23% growth. That's based on another 20 analysts. And in 2026, 18 analysts again believe that it's going to drop another 7.54%. After that, Fastgraphs has applied a very low growth rate of 2.38%, which, to be fair, no one knows at this point. iron ore prices go up and down unpredictably. It's very hard to predict where the price of this goes, which makes Rio Tinto the opportunity. Eventually it will, right? Eventually this earnings does grow a little bit. Eventually iron ore prices go up, demand goes up, and Rio Tinto has been storing supply. It can store supply, it can sit there forever if it wants to unlock it.
World steel demand will continue to be good. There will be more recyclability, which is good, and therefore slightly less demand for iron ore. China's demand is probably going to stabilize, whereas you see other developing countries like India growing significantly. But we see a good stable demand long term for our iron ore production.
So we're in a kind of storage phase for Rio Tinto right now. If at the end of 2029 we start to see a bit of an earnings growth, probably 12%, a little bit high for as far as earnings growth goes. Let's put it at 5.6%. So we see a 5% growth rate. If we keep it at this current PE ratio of 9, we start to see pretty good returns. We start to see 7.46% in year-on-year return. Now that's not a bad return for, a kind of dead dividend stock. And it's that kind of mix between risk, reward, diversity. I'm kind of taking it out of AI and I'm giving it to a British company that's in mining. It's totally different from anything else. I just like this to be out there, diversifying my portfolio and giving me good dividend return. At the moment, the dividend yield is 7.26%. That will go down, but that's what Rio Tinto do. It's kind of expected of them. I just hope the market understands that as well. So Rio Tinto is the final company that I will be paying for. I think it's in the down years of its cyclicality. I'm kind of ready for more pain. I'm ready to see 3,000 again, pretty much. And I'll probably buy a little bit more in then. Because Rio Tinto is a cyclical stock. And by cyclical stock, I mean in earnings. The earnings per share is up and down year on year. But it does actually grow. This company has grown over the years, despite the bumps. The stock price also follows these earnings, and I think that over the next few years, if the projected earnings can just stay above here and then continue to grow, continue to compound, I think Rio Tinto actually has quite a good chance of producing a good return. It hasn't produced a great return over the past few years. You have to go all the way back to 2008 before you actually achieve a really good return. A 15% year-on-year return is pretty good. It's better than bonds, but in the short term, it hasn't really done anything. So there we have it. That's my portfolio. There's the stocks I'm going to be buying over the next few months. It's a really choppy video. I'm going to chop the crap out of this one because I've made so many mistakes. Get in touch with me on the Trading 212 forum. Get yourself a free share. Get yourself a fast scratch subscription if you really want it. I'll be chatting away on the social part of the Trading 212 app, or I'll be in the comments below. Just ask me any questions and I'll generally be pretty honest with you. Oh, come on. How long have we been recording now? Oh, yeah. Did I mention? I hit 100k. I was supposed to do a big old video for celebrating 100k, but yeah, I hit 100k. Investing's supposed to get a lot easier from now. Doesn't fucking feel like it. I need a haircut.